So I would say that if what we see, for example, is the redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the U.S. economy actually deal with a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. Mm-hmm. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong shape. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong, still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way: our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that again supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get right now, supply and demand are really out of balance in many parts of the U.S. economy. The labor market being a big example of that. We need to get them better in balance so that inflation can come down. And that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim. That is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. Mm-hmm. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging. And I would also say that the events of the last few months have made it significantly more challenging. Thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
President Lagarde, can you talk to us about this?
Going on, I would say. But no, I guess I would, to put a more constructive spin on it, the markets and market participants are always wondering what we're going to do. They're always wondering what we're thinking. And when market moves happen, that's really a constructive thing. It's never going to be exactly what we're thinking, but nonetheless, it's constructive that the market in effect is doing your work for you if it correctly understands your reaction function. So that's maybe a more constructive way to
and is it correctly understanding what you're saying right now?
So I would say, by and large, I think over since last fall when we pivoted to raise rates and get where we are now, since then markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, the market pricing is pretty close to where the summary of economic projections from 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%, and markets are broadly right in that space somewhere. And then for next year between 3.5% and 4%. So broadly speaking, I think it's working. And we're all, everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now when you give the guidance and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like, markets lead and central banks follow because of the forward guidance.
It doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions tighten quite substantially, and we've only had 3 meetings at which we raised rates. Nonetheless, the forward rate curve is pricing in, a rate path that looks a whole lot like the summary of economic projections that my colleagues and I submitted in June. So that's a good thing. That's the market understanding and finding credible what we're writing down. Now, of course, it's all highly conditional, but nonetheless, I'd say that's a positive thing. Could I just add, we're talking a lot about markets and how we react to markets. Actually, to Christine's point, the way we're thinking about it is what policy setting do we need to put down to achieve the real economy goals that we're working on, and that's what we're not thinking, wow, let's try to match up with the markets. We're thinking, what's the right policy based on our, the incoming data and the evolving outlook and all those things that will get us to 2% inflation while ideally keeping the labor market strong. So it's really, we're talking so much about markets. I wouldn't want people to think that that's actually what we're aiming for.
We have time. Is there a piece of the? I mean, do you worry about yield curve inversion though? Is there a piece of that makes you worry, or do you just
So I would say this: we monitor a broad range of financial conditions. Honestly, the shape of the yield curve is not a top line worry for right now. Our focus is very intensely on setting policy in order to get inflation down to 2%. That's what we're working on. We understand that that's our primary focus right now. The labor market, of course, is extremely tight in the United States. So so our focus is getting inflation under control. It's very important that people understand how committed we are to doing that. And that again, that's what we're thinking about.
Yeah, and I want to go back.
And we would take that into account in our policy. So as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And it's what Augustine was speaking to earlier. A low inflation environment or regime is what we've had. And that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening, and we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Is there a point where actually inflation expectations get de-anchored? And is that...
That's another way of saying it or thinking about it. It's the same thing, same idea. And the thing is, you never really know. There's no way to know in real time. We all study inflation expectations very carefully, and if you look across the broad scope of short, medium, and long-term expectation, you'd still say that we have credibility, that they're well anchored. But there's a clock running here where we have high inflation running now for more than a year, and no one should assume it would be bad risk management to just assume that those longer term inflation expectations will remain anchored indefinitely in the face of persistent high inflation. So we're not doing that. As a risk management matter, we're working very hard on the part that we can affect, which is the demand side. We can't affect the supply side really, but we can affect the large parts of the U.S. economy where there's surplus demand, and that's really our focus.
Is there a data point that you watch for to actually see whether there is a de-anchoring, or where do you see it first? Basically, if it spirals.
The point is not to see it at all. We can't. Once we start seeing that, the cost of dealing with higher inflation goes up so much to the extent you find yourself in a higher inflation regime. That you just can't allow it to happen. So if you're starting to see serious de-anchoring and we're not, of longer term inflation expectations, then you're behind. And I think right now we're doing what we need to do, which is to move expeditiously and into restrictive territory fairly quickly. I think that's what we need to be doing so that we don't find ourselves in that situation. We now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted. I was looking at our at the time of our June meeting 1 year ago, of the 35 people who filed with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, it was way above 4%. So really everyone had the same model, which was the Phillips curve model, and it just was not capable of producing high inflation. But what it was missing was something that's completely missing in the data for 40 years, which is basically a collapse of the supply side. Yeah. The U.S. economy is famously adaptable. It has the minimum of structural rigidities, all that kind of thing, and yet here they are. So what you had was very strong demand, but hitting effectively a vertical supply curve. So ordinarily, when people want to buy cars, which they really did because they didn't want to ride on public transportation, rates were low, they had all these savings, the car companies would make more cars, and they might raise prices too. In this case, they couldn't make as many cars. So what you got was straight up the vertical supply curve, a big price increase. But I also think, in principle at least, that process could work in reverse, so that as demand comes down, inflation could actually come down more quickly there are other relationships that people think about when they think about how do you get inflation down, which are more typical of a simply overheated economy and entrenched inflation, the sacrifice ratio and those kinds of things. But I think this could be, I don't know that it will be, but it could be different because it's just that process working in reverse potentially.
Do you see that process, President Lagarde working in reverse? So actually, I know it's different because,
like Andrew, we don't have responsibility for the level of the dollar. That's the elected government's job. That's the Treasury Department's job. And so it's just another financial condition to us. And since our economy, the external sector in our economy is so much smaller than it is for the others here, it's not that important. But dollar has been strong, which would tend to be disinflationary, but only at the very margin. I think
would help in setting monetary policy. Only one thing.
Yeah, no, I'd go back to the same thing really, which is what did we get wrong? And that really was looking at these supply side issues and believing that they would be resolved relatively quickly. And by that I mean there were going to be vaccinations, everyone would get vaccinated, so the millions of people who dropped out of the labor force would come right back in, so wages wouldn't be under such pressure. That didn't happen for a range of reasons. It didn't happen. In addition, the bottlenecks and the shortages haven't been alleviated yet. And then on the back of that comes the new shock in the form of the war. But it wasn't something wrong with our models, because it wasn't in the models at all. It was a question of how to assess the persistence of these supply side shocks. And I do think that there'll be, to Augustine's point, and there is a lot of work going on to get smarter about the supply side. In the nature of it, though, it was a deep in the tail kind of a risk, and those are very hard to predict and assess when they come.
Yeah. Impact our economies going forward.
So there's certainly a threat of that, and this is not the work of the central banks, but I do think it would be a plus if we were to find a way for China to take part diplomatically and economically according to a common set of rules, and that would be a big plus for global growth if we could get back on a path to that. But it's obviously that's the work of elected governments, not for us. In terms of globalization, yes, I mean you can imagine a world. It's not hard to imagine a world where we break into these blocks again, and that would be a world of lower productivity and lower incomes over time. It doesn't have to happen that way. People are looking at shorter and more durable supply chains. It's not clear how much of that will happen, and if so, what would be the effects. That could be more secure, but perhaps not as efficient as the long but fragile supply chains that we've had So I think it's a very important question, and there's certainly a risk that the benefits of globalization would be lost. But obviously, there were benefits and there were costs to the advanced economy. Certainly, 10 years were so far the height of the disinflationary forces that we faced, and really it goes back before the global financial crisis, but really since the global financial crisis, we had very low inflation. In the United States, we had 3.5% unemployment for a couple of years, or right in that range for a couple of years, and inflation didn't react at all. So we had that gave us the ability to really lean into the maximum employment mandate, and we did that. And I think that was the right thing to do in that world. That world seems to be gone now, at least for the time being. And we're living with, as I mentioned at the beginning, we're living with different forces now, and have to think about monetary policy in a very different way. So I think if you want to know the lessons to be learned of the last 10 years, look at our framework. Those were all based on a low inflation, environment that we had, and now we're in this new world where it's quite different with higher inflation and many supply shocks and strong inflationary forces around the world. It's quite a different environment.
Trade policy, especially as the Fed.
Yes, I do. I would just say, I think that in economic discussion generally, there's much too much focus on demand management and not enough on things that will make us grow at the maximum sustainable level, sustainable growth in the longer run. There's not enough focus on that. And that isn't the Fed's job. That's more the job of, again, elected governments. But I'd like to see more of that. So I'm kind of out of the business of giving advice to the fiscal authorities these days. So I would just say, I think when I get asked that by an elected representative, what I say is focus on investing in people and investing in things that will increase the productive capacity of the economy over time. That's what I say. And in terms of, I think what a central bank should do is stick to its knitting and do its job, and leave the major issues of the day to the elected representatives. How the pain people are going through dealing with higher inflation, that we have the tools to address that and the resolve to use them, and that we are committed to and will succeed in getting inflation down to 2%. The process is highly likely to involve some pain, but the worst pain would be from failing to address this high inflation and allowing it to become persistent.
Welcome to the Crypto Teacher. And guys, I come back with that video just to make you think. And Jerome Powell was in the house yesterday, and I told you I was going to bring you this video. And Jerome Powell states the United States economy is in great shape. Yes, you heard that correct. Gas prices sky high. Food prices sky high. And Biden says you just have to deal with it. And Jerome says he's not worried about the yield curve. But we know better. Inflation was caused by Congress and the Fed. The NWO caused the problem. Wait for the reaction and run in with the solution. And Walmart and Target said something very, very important. They're only going to have products that their people want. And guys, how do they know that? All this data they've been storing in the cloud. They're about to turn it on. And because they already know what you want, they need less employees. Guys, automation is coming, and I suggest you get prepared. The fourth industrial revolution is going to end America to Babylon as we know it. And remember, the Crypto Teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.